Welcome to This Explainer. Today, we're cutting through all the financial noise and getting right to the mechanics of an absolute powerhouse for your personal finances, the mutual fund. We hear so much jargon thrown around out there, right? But today, we are keeping it incredibly simple and focusing purely on the foundations. Let's get right into it. So, be honest with yourself for a second. Do you want to invest, but just feel totally overwhelmed by the stock market? If you're nodding right now, trust me, you are absolutely not alone. The stock market can seem like this massive, daunting, expensive, and, let's face it, risky puzzle for beginners. You see all those tickers flashing red and green on the news, folks analyzing complicated charts all day, and it just feels, well, completely inaccessible. But there is an incredibly elegant solution waiting for you. It's a structured way to get in on the action without the massive headaches. Section 1. What is a mutual fund? The core concept. Okay, so a mutual fund is basically a financial vehicle. And honestly, I love that word vehicle because it implies it's actually going to take you somewhere, right? So what does it do? Well, it pools money from many different investors to purchase an incredibly diversified portfolio of securities. We're talking stocks, bonds, and short-term debt. Basically, instead of going to the market all by yourself with just your own wallet, you're joining forces. You're bringing your money together with others to buy a huge, varied basket of financial assets that, let's be real, you could probably never afford to buy all on your own.
Section 2. How mutual funds work. Peeking under the hood.
Think of this whole mechanism like a giant financial carpool. First step, you pool money. Instead of trying to buy individual stocks entirely on your own, you and thousands of other everyday investors pool your cash together. You're basically chipping in for gas. Second step is professional management. Because, this massive pool of money doesn't just sit there doing nothing. It gets handed over to a professional fund manager. They are the ones actually sitting in the driver's seat, doing all the heavy research and making the really tough calls about which specific securities to buy and sell. And finally, step 3, to get your seat in this carpool, you just buy shares or units of the fund. Now, when you buy those shares, you aren't just buying one specific whole stock. Instead, you're securing a fractional share. That fractional share represents your exact, mathematically precise slice of the fund's entire overall portfolio. And honestly, here is the absolute best part. It also represents your proportional claim to whatever income that portfolio generates. You own a tiny slice of the entire pie. It's just brilliantly efficient. Moving on to Section 3, key benefits of investing, and why this matters to you. The contrast here is actually pretty striking. If you decide to go the route of picking individual stocks, well, that requires hours and hours of intense market analysis. Plus, unless you have massive amounts of capital laying around, it's virtually impossible to buy a widely diversified portfolio all at once. But with a mutual fund, you're getting professional expertise actively monitoring the markets for you, paired perfectly with the affordability to start small. And why does this matter so much? Because you don't need millions of dollars to start investing. And you definitely don't need to be some Wall Street whiz spending your precious evenings analyzing financial statements. A professional manager is already doing the heavy lifting for you. Let's actually zero in on that affordability aspect for a second, because it is an absolute game changer. You can start with a relatively small amount of money. Think back to that idea of pooling resources. Because of that massive pool, you can jump into a highly diversified, professionally managed portfolio with just a tiny bit of cash. If you tried to independently go out and buy even a single share of dozens of top-performing companies, you'd need a small fortune. But a mutual fund completely removes that massive barrier to entry. And the really crucial point here is diversification. By investing in a fund, you instantly own a tiny slice of dozens, or sometimes literally hundreds, of different companies all at once. This spreads your risk out beautifully. I mean, imagine holding just one single stock, right? If that one company has a terrible year, your entire investment tanks. But with the built-in diversification of a mutual fund, if one company in the portfolio performs poorly, you've got all the other healthy companies in that massive basket to help balance out the loss. It acts like built-in shock absorption for your hard-earned money. Now, I know a super common fear is that your money is just going to get locked away where you can't reach it. And that brings us to NAV, or net asset value. This is simply the current price at which your mutual fund shares can be easily redeemed or sold back on absolutely any business day. This means mutual funds offer incredibly high liquidity. You never ever have to worry about your money being permanently trapped. If life happens and you need your funds, you can just easily sell your shares back at that day's current net asset value. It's totally transparent, and it honestly just provides incredible peace of mind. Wow, we have covered a ton of ground today, right? We've navigated through the mechanics, fractional ownership, and the really undeniable benefits of professional management and diversification. So, I want to leave you with one final thought to chew on. Is your money working as hard as a professionally managed fund could be? Take a good look at your savings today. Think about this incredibly elegant financial vehicle we just explored and ask yourself, is it finally time to put a professional in the driver's seat? Thank you so much for joining me on this explainer.